Welcome back, everyone. Hope you had a good lunch. We're here to talk about fundraising and LP relationships. My name is Brad Gersich. I'm the head of the corporate practice in Northern California for DLA Piper. I'm the one who helps a lot of the funds deploy the capital and get liquidity events. I'm here with two of my partners, Yoni Tuckman and Ken Mueller. They're in our fund formation group. They're leaders of that group, and they work with a lot of funds and the managers and the LPs themselves. And so we have slides and fancy information, et cetera, because we want to get you CPE credit. But we really didn't want to just talk at you and have you guys look at screens. We kind of wanted to structure this more as a conversation, like three guys in the office talking about trends and things that we're seeing. We thought that would be a little more interesting in terms of style, but also we thought it might invite you guys to participate. So throw spit wads at me, like raise your hand, interrupt me, whatever you want. If you want to follow up on something, we'd love to get your experiences into the mix of this conversation. So again, welcome Yoni and Ken for here for this conversation. Oh, and just a reminder, CPE credit, sign up outside. So we want to just start by kind of going a little bit backwards, taking a look at 2024, our little tailwinds as we came in here. Tell us a little bit what you saw last year, what you know from your research and your experiences about 2024 as a fundraising environment, and any lessons from that compared to previous years.
I'm going to answer that question. And before I do, I just want to give you a little bit of context who I am so you know to take what I say with however much or however little salt you choose. I'm a fund formation lawyer in LA, very agnostic as to the type of funds. So we'll raise, if you have a fund, we'll raise it. Funds are us. So nothing too big. Everyone says nothing's too big or complicated, but also nothing's too small or simple, because from the smallest seed grows the greatest oak, right? Venture capital, I assume by a show of hands, most of the GPs in this room are venture, growth equity. I don't see any hands, but yeah, right? So we're in the valley. But we'll raise private equity, real estate, credit. So when we talk about the market or what we've seen, we have to define that a little bit. Like in what private markets, we see a lot of private markets. So we talk about venture capital. We talk about venture capital that's going from Fund 6 to Fund 7, or we talking about Fund 1 or Fund 2, right? Everything is a little different. But what I'd say broad strokes is that this past year has been a mixed bag, okay? On the one hand, fundraising was atrocious. So anyone who's sitting in this room and felt they underperformed last year, I want to tell you most of what I do as a lawyer is not law. It's mostly therapy, teaching, coaching, Sherpa-ing. And so what I would tell you is don't feel bad. You're among the best. It was hard for everyone to raise money last year. That's because there were kind of institutional headwinds that were kind of coming into the year. But the good news, I think, is that those headwinds, I think, have now started to turn into tailwinds. And so there are other things that happened in 2024 where even though it was hard to raise money, it's probably going to be a little easier to raise money as we progress continuously into 2025 and onward. What are those things? I wrote down a few in preparation for this.
Hold on. Why was it hard to raise money in 2024?
Yeah.
What were the reasons?
Yeah, I mean, well, there was a lot of uncertainty in the market, right? In a lot of different ways, some of which are still here and magnified.
So the election?
Something.
Okay.
I don't think that really had something to do with anything in January and February, but there was a lot. And well, tell us, Ken.
I'm curious. Interest rates? Were interest rates effective?
Here's the thing. So let's peel back the curtains. I'm so glad you asked. So people ask me, what are the trends? And I'm sure we'll ask that as well. What are the trends? What are you seeing? And I always answer people and say, what are the trends in the market? Say, you know what? I'm one guy working with my clients. I don't have the world. I'm not a seer. I'm not a prophet. And I would say I'm not an economist. So I can't tell you why things are the way they are from an economic, a macro perspective. I read the New York Times sometimes. I read the Wall Street Journal. I know that things are complicated in the world. But for years, it's been difficult. After 2021, which is kind of an anomaly, when there was a lot of money being raised, things have been tough for everybody. I think, though, that because in 2024, and tell me if you disagree, Ken, there have been a lot of, in the PE market, there's been an uptick in exits. And in the VC and PE market, there's been an uptick in deal flow and deal execution. Now, I'm not, Brad, you can speak to this. The more deals that are happening, the more foment, the more likely it is that there's dry powder that needs to be put to work, right? Because we're already depleting what we have, or we're going to raise more money, and LPs see that the money is being put to work. And so that bodes well as we move into the second half of this year and further, and the other things that we'll talk about why I think that fundraising will continue to improve.
Just from my perspective, working with a lot of the funds, especially in the private equity side, they were digesting so much of the activity from 2021, 22, 23. These companies there's so much deal activity. They're building and building and building. And last year there was almost this, just like, we've got to take the foot off the pedal a little bit and actually make sure these things work, that these Frankenstein monsters that we put together. And so there wasn't as much deal from a fundraising and let's just make it work. Let's operate these businesses that we've created. And now I kind of feel like as we get into this year, you talk about tailwinds, the fact that they paused for a moment, the fact they didn't deploy as much capital, the fact they didn't raise as much money means now they have that itch. Like they don't make money, they don't win if they're not active in the fundraising and fund deployment side of things. That's really what the business is. And so I'm more optimistic that engine's going to churn up here over the rest of this year, in part because of the retrenchment of last year.
I'm concerned. I mean, I guess from my perspective, I watch the news every day, and I don't know exactly what's going to come out of Washington, D.C. So, whereas in January, I think people were of this mindset that we're going to be in a business-oriented environment, tax rates are going to come down. Right now, there's so much uncertainty that I personally can't predict or tell people which way things are headed, whether it's global inflows of capital, tariffs, taxes, et cetera. And I see it in the deal side. So what used to take a few days to get a deal closed and negotiated and documented is now taking a couple of months, and people are taking their time. And on the client side, my clients are less happy now than they were previously. Part of that is, I think, because of uncertainty and concerns about a recession. So everybody starts looking around the room and the pie is shrinking and saying, what can we do better? Who's potentially extraneous to this puzzle? So there's that issue, deals taking longer, and then I think just investors being more cautious just over the past couple of months. I do believe that this is kind of a U.S. phenomenon, and that in the rest of the world, based on my experience, there is less uncertainty. So my personal experience over the past 18 months has been that Europe has kind of come alive. We're seeing investors making huge commitments and embracing ESG and embracing DEI and going against what's happening in the U.S. and deploying money for global programs at a much higher pace and velocity than what is happening in the U.S. right now. So maybe this is just a U.S. phenomenon. Fortunately, we have got 5,000 lawyers globally and 100 plus offices at DLA globally, so we're well positioned to potentially work on some of that.
It's called product placement.
Yeah.
The other thing is, I would tell people last year, because how was the year fundraising-wise? And it was two different stories. And this gets back to something I said a couple minutes ago. You could read the papers and the trade magazines and hear one thing, but then you could experience something totally different. So I didn't see last year a downtick. I thought we were very busy over the course of the year. There were a couple slow months. Last summer was very slow. Just looking at the metrics that I'm looking at, how many lawyers are working hard, right? The summer was slow, but the year was very healthy. This year, it's been very healthy. And so, again, you turn on the radio, whoever turns on the radio, you listen to your podcast, and you hear like all of this tariffs and trade wars, and everyone's scared. But when I get to the office, I have 1,000 emails from existing funds, from new emerging managers who are looking to deploy funds, raise funds. So I'll be honest, it's a little bit like the emperor has no clothes. We can get up here as experts and tell you, we can repeat to you, we can recite to you what the talking heads tell us about the economy and where it's going and what you should be worried about or optimistic about. At the end of the day, that's fine. You could all read that yourselves. But really what we can offer you is our personal, anecdotal, and just experiential perspective. And from mine, at least, is that things are good, at least where I'm sitting and seeing. So let not the heart be wary. Is that the expression?
Are there certain sectors, though, that are getting more attention than others as we go into this year? In terms of the fundraising, is the thesis of the funds changing from last year or years before?
I don't think so. Look, AI, I heard this morning talk about AI. AI is what everyone's talking about and is driving a lot of venture fund formation. I have a funny story I have to share with you. Not a client of the firm. A friend of mine has a startup. I was hanging out with him last week, and he told me he went to a certain city, which will remain nameless. It's a valley. And he went there to raise money from VCs. And he and his partner had this deck that they brought. And his business is going really well. Like he tells me it's profitable, it's revenue generating, it's got great strategy and great vision. And the one thing he kept hearing was, but where's the AI? Where's the AI? So he literally told me that night, he went back to his hotel room, he took out his deck, he revised it. The business isn't changing, but the deck changed. So now the deck, every other page talks about AI, what AI is going to do for this company. And it worked out very well for him. So,
It reminds me, like I've been around a while. I started my career in '97, and when everybody changed their name to .com, Inc., suddenly everybody had interest. It's 25 years later. It's the same thing.
Right. I mean, outside of venture, there are things. I mean, even through 2024, when things were not good, infrastructure was still strong. I don't think there are many infrastructure GPs in this room.
Private credit.
Private credit has been strong and continues to be strong. I think private credit probably grew over the last a small percentage at least. So what I would describe as an optimistic, I would even say, I don't want to say rosy environment. There are certain funds that have, not funds, certain asset classes that have done even better and weathered the storm more. But I think things are looking good.
Okay.
So talk a little bit more about the LP mindset. You've got fundraising, you guys are working on deals, so obviously some fund managers are winning the mind share of their LPs. Has there been any change in the mindset of LPs over the last 18, 24 months? Is AI just stuck in their head and they're looking to invest in that? Is it based on sector? Is there anything new other than, what's your returns from last year or last 5 years or last 10 years? Is it the same conversation with LPs, or are there new things? Like you said, in Europe, is DEI actually matter to them in a way that even more so now, since it's not something that is being emphasized in the U.S.?
Yeah, I think from my perspective, like I said, it's really the U.S. is putting itself in a bit of an isolationist perspective. The LPs in the U.S., whether or not they agree with the administration, I think are being more cautious than they were. And so it's taking longer to put deals together. We're getting more questions, more friction, and LPs being more cautious in the U.S. And really just the opposite outside of the U.S., where if you've got a global program and you're interested in investing globally, whether it be technology or other types of products, the non-U.S. investors are very keen to do business and working at a fast pace to get deals done.
So they're getting done faster.
Yeah, I mean, that's my perspective.
Yeah.
Ken, when you talk about the pace of deals, do you mean the fundraising for the funds or the deployment of the capital into?
I'm talking about fundraising for the funds. So, I mean, I'm closing a deal right now that it's taken maybe 2.5 months with an LP. I would have expected it to take 2 weeks, 3 weeks. And it's a U.S. investor, and I think part of the problem is that they're not exactly knowing which way the economy is going to go, so they're being more cautious than they would be otherwise.
So are they slow?
And I don't see that outside of the U.S.
Are they slow pedaling are they negotiating with you on terms, and they're kind of like being really slow getting back to you on the turn of the docks because you think they're just buying time?
Exactly.
Yes and yes.
Exactly. Yeah. Yeah, and like I said, I mean, it's just a sort of general questioning. When we do continuation funds or we do cross-investing between funds, there's always a conflict analysis that has to be done, waivers that have to be collected, potentially raising more money. That's much harder now than it was a year and a half ago in the U.S. LPs are asking more questions. I think people are genuinely concerned about their jobs. So they're trying to protect their record and make sure the file has what it needs in order for them to bolster their decision. But they're also, just slowing down. And in the great financial crisis, you saw this. I mean, the U.S. was closed for a year. Basically, all of the U.S. investors weren't doing any deals. So it was all non-U.S. investors and non-U.S. investors coming into the U.S. and buying the U.S. at a discount. I would say in '99, we had this big run-up in venture, and then 2001, 2002, venture became a dirty word, and everybody moved into private equity and growth equity and said that they were never a venture capitalist, and that persisted for about 3 years. So you see the money, keeps flowing, but it's shifting from sector to sector.
Yeah, I mean, that's what's interesting, and two people can have three opinions. There's so much variation in people's personal experience. Let me ask you this, Ken. Have the terms of your fund changed in terms of, have you been putting in longer fundraising periods this year or last year than prior years because you're seeing this slowdown? Or if not, do you plan on putting longer fundraising periods in going forward because of what you're seeing now?
Yeah, I think there's an acceptance of longer fundraising periods right now. I think that people understand that it's a challenging market. So if you start with 12 months and you have to push to 18 or even 24, there's some expectation and acknowledgement among the investors that's probably okay, even for very well-financed programs.
Right. In my perspective, in my experience, the fund terms in this particular...
Not yet. No, I would say they haven't really changed yet.
Right. I mean, for as long as I can remember, I've been putting in the fund docs that your fundraising period is 12 months plus 6. That's how I do it, 12 plus 6. So you get 18 without saying 18. But usually, I mean, once in a while there are extensions to the 18 months, but I think that was probably always the case. You'll have some exceptions.
Are there any other features of these fund documents that are kind of more common now than they had been in the past? I've heard a lot about co-investments and those kinds of things. Is any of that in the mix?
Let me tell you a small story. When I was a baby lawyer, I was just cutting my teeth learning I showed up to my first day after law school at a law firm, and they said, you're going to be a private equity fund formation lawyer. And I said, what's a private equity fund? I didn't know what it was. So I was learning about it, and we used to represent a lot of like very big pensions. And they would come to the office and they would kind of meet with the lawyers explaining why it is that they're investing in private equity and venture and the private markets. None of that has changed in the last 20 years. Like, these players are always going to be, David, am I right? All these players are always going to be investing in this asset class because it's diversification, because it's less susceptible to short-term, fluctuations in value and volatility, and longer term, over time, higher performing. So the fundamental market rationale for the biggest investors in this space, which is the same fundamental rationale for the smallest investors in this space, they're all investing for the same reasons, that to me has not changed in 20 years that I've been doing this. And the terms of the fund haven't changed either. Questions about trends are always things that make me chuckle because, again, maybe I'm missing something, but what are the trends in the terms?
But on co-investment, I mean,
yeah.
I would say that it's true that everybody has always asked for co-investments. It is also true that most of the time investors don't take advantage of co-investment opportunities, particularly institutional investors, because they can't move quickly enough or they don't want to be responsible for the decision. What I've seen is over 15 years, greater acceptance of co-investment vehicles. So we'll raise a main fund, and then we'll raise a sidecar for an investor that's a co-investment vehicle. It'll be there to suck up any excess opportunities or opportunities that are too large for the main fund. And historically, those were not huge, and now I see them getting larger and larger, hundreds of millions of dollars in some cases, and a very institutionalized approach where they're putting so much money up that they do plan to use it.
Right. There are themes, I agree. We agree on some. There are themes. Co-investments are, even for someone like me who has maybe a deficit in pattern recognition, co-investments are more common, GP-led secondaries, and that question of what do you do at the end of the fund's life when you have these really good investments you're really not ready to part with, but your investors, or many of them, are itching for exits and liquidity. Those are trends that I'm seeing for sure. So I agree. Structurally, those things are more discussed even on the front end. A fund is, clients raising a fund. We'll talk to them when we do the term sheet for the fund. We'll say, okay, what's the term of the fund? 10 plus 2 plus 1, whatever it is. Okay, what are you going to do at the end of that? Well, that's a decade away plus. Okay, but what are you going to do then? Chances are you'll have assets that you're not going to be ready to part with. Do you build into the documentation a roadmap today, how to handle that 12 years from now? I'll tell you, in real estate, that's very common. We're going to build in like this REIT roll-up provision into the real estate fund docs that give the GP and the LP certainty as to how everyone will be treated at the end of the day. And maybe that's something that people should be thinking about. It is something that people should be thinking about when they're raising a new venture fund. And the answer may be, let sleeping dogs lie. We don't need to worry about that now. We'll deal with it at the time. And that's usually, I think, the right answer, but it doesn't mean it shouldn't be kind of discussed as a theme of something that's evolving.
Yeah, if things start to continue to slow, you'll start to see pressure on fees again. And so management fee offset, obviously, but actual management fees, larger investors negotiating institutional discounts, if you will. And that's pretty common at this point, and I think it'll accelerate.
Yeah.
In other words, if the economy's bad and the investors understand that the demand for their capital is increased, then they're willing to push a little harder on some of this.
Yeah, agreed.
But overall, the confidence in private market investing, venture funds, growth capital funds, private equity funds, you don't see that waning. You don't see a significant change in attitude towards those investment classes. And is there any enthusiasm for one of those three over the others?
We may have a difference of opinion on this very stage. I don't know. I'm not seeing that. I'm also not aware that there's more enthusiasm for one or another. I think like the big allocators have their allocations and they're allocating across the board. They have to keep their allocations. Those don't change from year to year.
But when the market drops 20% and the denominator effect kicks in,
yes,
it does change their allocations, and maybe they cut back a little bit, or they cut a few groups loose that they weren't sure about.
Yeah, but not as between venture and growth equity, to my knowledge, right? Between public and private, markets for sure. Yeah.
The last few months, you think it's just going to reinforce people's loyalty to private markets, and what you think you describe it as at least greater stability.
That's what I read. I'm not a seer, but
we'll have to see.
I'm not a prophet.
We'll have to see.
Yeah, we'll have to see. Come back next year. We'll see who's right. Check us.
So any differences in approach from limited partners in terms of the actual managers themselves? Obviously, you've got returns of these managers that they tout all the time, but anything about the selection process, you're dealing with both sides of these conversations. What are the factors that come up in those conversations, say, yeah, this is where I want to put my money versus, yeah, I like their returns, but I didn't like this.
It's fun. I know we're not using the slides. There was a slide. I got some data on this, at least from one, source, and it ranked as the most important factor among LPs in determining the managers they were going to back. It was the sector expertise. It was a sector expertise, which didn't shock me. But what surprised me is how. And another thing that I saw is that ESG fell precipitously in kind of what LPs are valuing in their sponsors, which also didn't surprise me. But what surprised me was that the LPs, like the track record, didn't rate as high on that totem pole as I would have thought. What I tell emerging VCs for sure is the difference between make or break this fund often will be your track record. And emerging VCs often struggle with track record because they're emerging after all, and they don't have access to necessarily a track record. But the more you can tell a story of a track record, of a team, that's going to propel you much farther than a vision. Because a vision and $2 gets you on the subway, right? But a track record you can take to the bank. We've done this. We've seen this.
What if the track record's irrelevant, though, because the world's changed? And I think that just gets to deep sector expertise. In other words, you can't count on the track record because investing in chips and software is not what it used to be, and that may be a big part of a venture capital firm's track record.
Agreed. And with sponsors that I'm working with who are very often emerging managers, raising their first, second, third fund, they're not their track record, right? It doesn't mean the other stuff you used to invest in, you did really well. So like, give me your money now to invest in like a new asset class. Like I'm a great real estate investor, so look at my track record. I'm going to invest in venture. That's obviously that wouldn't work. I can't invest in chips and now I'm going to invest in AI. It means track record means apples to apples. You invested in this area, you're continuing to invest in the same area. And if the world is changing, you're investing in a different product, then you're right. That's not really your track record.
Yeah, so I had a client say to me yesterday, we've been talking about doing a GP stakes deal for a couple of years. And we've traded presentations and valuations, but as the valuation expectations have come down, the client said to me, that trade's over. So even though there's a ridiculous amount of capital that's been raised for GP stakes transactions, the client's perception was, not now. It's not the right time for that deal, because what will be offered for our stakes at this point is a fraction of what we would have been offered a year and a half ago. And that's a whole sector now. I mean, that's a whole... Agreed.
That you can add that to the list of new developments, right? Trends, if you will, or, co-investment products, GP-led secondaries or other continuation vehicles, and GP stakes deals. I mean, add that to the list. Someone not investing in your fund at all, maybe, but just investing in your GP and your manco. or both. Seeding your fund is very common among emerging VCs. You get a good investor into your first fund, and they'll say, I'm not just an investor in your fund, I'm also going to be sitting shotgun with you as you ride this thing. So we're going to own a piece of your Manco or GP from Fund 1, going into GP of Fund 2, and those are a whole world unto themselves in terms of how those transactions work. There are many different ways to do that. But that, I think I would add that to the list of kind of newer, not new, but things that I'm seeing more of than in past years.
So I'm not familiar with the GP stakes approach. Can you talk a little bit more about the terms or how that's structured?
Yeah, I'll tell you what it means to me, and then Ken, you may have a different experience with different types of clients. But emerging venture firms will not infrequently get interest from other funds that are dedicated towards this. We're raising one right now with the client. What they're going to do is go and seed, go find really good emerging managers, and they're going to put money into their funds, and then they're going to put money into the GPs to help them with their GP co-investment. And then in exchange for that, they'll get rights, not economic rights just as an LP in the fund, but they'll own a piece of the carry in the fund. Maybe they'll even own a piece of the management fee, which is all the emerging managers in the room. I know you're thinking, what? This is my lifeblood here. I can't be giving this away to some rich, family office is going to back me.
What do we talk about in terms of percentage? When you say some part of the carry or some part of the management, like how much is on the table in terms of a range?
Yeah, it really depends. I would say between 10 and 20% is what I often see of the carry. We try to avoid GP stakes that touch the management company at all, whether it's an actual ownership stake or revenue share. I just think that's, we try to avoid it. Sometimes we can't. But then it's the question of how do you get this guy out, right? Like they're in your firm now.
No, you don't want them out. You don't want them out.
No,
They're providing capital and
you do want
stability.
them out.
Hold on a second. The other end of the spectrum. The other end of the spectrum is the successful fund that's doing Fund 8, 9, 10. We've got a bunch of founders in their 60s and 70s. A bunch of them could turn the reins over to the next generation, keep a piece, or in part of that, retire their interests and sell them to institutional investors. And that, I think, is where we've seen the most growth in terms of dollars and interest over the past couple of years. Those deals are generally less than 25% because of the Advisors Act consent rules. So if you sell more than 25%, you need LP approval to do that. But that's an asset class now where billions and billions of dollars have been raised. And if the founders or the folks who 2 years ago were looking at potentially hiving off a part of their firm because the economics were so beneficial to them, if those valuations have compressed, it feels like we're going to be seeing less and less of those types of transactions. But just to sort of answer your question, I mean, the spectrum, I would say, is from a public company parent that has private equity professionals working for it, where the standard deal is that 50% goes to the house and 50% goes to the professionals. That's like the ultimate GP stake deal. And you get the benefit of the administration and the accounting and maybe the distribution network of the public company parent, very common in Wall Street, all the way to a 5% deal or a 10 or 20% deal with a GP stakes firm being in the middle of that. And then, maybe it's a placement agent who comes in and says, hey, I'm going to help you raise a couple $2 billion in exchange for 10% of your carry or 5% of your carry. So you do see sort of wide variations on how those are structured. But the big deals where the mature firms are selling out a piece of their firms, those are essentially M&A deals where the agreements are now structured as M&A agreements and you're sitting with that financial partner indefinitely. Or maybe there's a buyout after 8 years, 10 years, something like that.
Right. If you're bringing someone in the earlier stages of your firm's life, often if it's not structured as a pay-to-play, as in you're not just getting a piece of my firm today because you're seeding my first fund and help putting me in business. You're going to get something of that, but how long should that live? How long should that last? Is that you get like my firstborn child? Like at what point do we say, thank you for seeding me, but I have to go live my very best life? And so that's what I meant by, in that respect, you need to have an exit. You need to have a way to get them out, and it could be done in a number of ways, but.
Yeah.
Before I move on to the next topic, I did want to just throw it out here for the folks who are involved in fundraising conversations. Are there any questions you are asking now or questions that you've been asked that are novel, that are new in the last 6 months that you just hadn't heard before? Pretty much the same conversations?
I don't think anyone will raise their hand and be the one person to raise, but
And I'm just
please.
curious to information gather. All right, then to shift a little bit, I wanted to talk about something you brought up, which is end of life.
Yeah.
Right, we're in part because there's kind of wobbliness for exits and valuations, et cetera, especially in venture and growth. What are folks doing? How are they addressing the issue? And is there any kind of dynamics throughout the industry that are responding to this need and that pressure?
In my experience, it's a conversation that I always want to have with the fund. Think about what's going to happen in 10, 12, 13, 14 years. And like I said before, see if there's something you want to build in today to deal with that. Usually the answer is no. And then usually when that case arises, another thing to think about when you're conceiving of the future is, do you build a roadmap, or maybe the term of your fund needs to be recalibrated? Like maybe the term of your fund itself, ought to be a longer term fund than the standard 10 years. Maybe that's appropriate, even if you're not going to build in like this mechanism to convert the fund to sell assets to a continuation vehicle or whatnot. But if you're in that predicament, which is a good predicament, it's a good thing to be there. It means you have a successful fund and you have an even more successful, company or two or three. So then it's a transaction, and you go ahead and you form, many different ways to do it, but it's essentially an M&A transaction with you form a fund, it buys the assets from the existing fund. Some LPs who are in the existing fund may roll over into the continuation fund because they want to be along for this ride. Others want to get out, they can cash out. So there's a lot of flexibility. And my view of things generally is, I was trained this way, is the KISS rule, the keep it simple, stupid rule. Don't over-engineer and don't overthink, and keep it simple and things will work out, and because they typically do. And so I don't really like the over-engineering on the front end to deal with something that may or may not happen in 15 years. When there are solutions to deal with those things, if and when they do occur, it's probably not necessary, but that's how you deal with it.
Ken, do you see more the coalition of the willing from the existing funds creating these new entities to carry forward, or are you seeing more and more secondary funds popping up to say, we're here because of these folks who want to get done and wrap it up, and they don't want to do it anymore?
Yeah, so the secondary funds tend to do really well when there's a lot of distress in the market. So, for example, the great financial crisis, the secondary funds were able to buy assets at tremendous discounts. The backwater of that, with the Bank Holding Company Act, basically outlawing private equity investments for banks, resulted in banks unloading interests in rapid fire fashion, bulk fashion. That resulted in tremendous purchase of assets at discounts. I think other than when there's a crisis happening, occasionally you'll see an investor say, hey, we want to cycle out of this sector and move, our money elsewhere. So there's activity, but it's not frenetic activity. For firms that have assets, funds that have assets, it's not always viewed as a success if we're in year 12 and we're still holding on to, some company that is not attractive enough to be purchased by anyone else. But I've had funds that start at 10 and wind up going to 12 and 14, 16, 18 years. And the simplest thing is just to extend. The quid pro quo is often, okay, no more management fees, and we're going to figure out a way to try to reduce the audit costs to as close to zero as possible. But we're going to continue to hold these assets and try to manage them out to reach a successful outcome. Interestingly enough, if you hang out long enough, your investors may change. So within, for example, state pension funds, it's very common for the investment professional who interfaces with the fund to rotate in and out over 2 or 3 years. So if you're in year 10 and the person is putting tremendous pressure on you to sell these assets and dissolve the fund, they might rotate out in 3 years, and you might wind up with a different person or group of people who look at the asset differently and are more inclined to say, hey, why don't we let this play out? So time can be your friend, depending on which side of the equation you're on.
Indeed. Speaking of time being your friend, maybe we can talk about regulation a bit, because an interesting email this morning there are the AML rules that FinCEN came out with this year, the Treasury Department, requiring that not only registered investment advisors, RIAs, but even exempt reporting advisors like venture firms often, who are not registered as the SEC as investment advisors, need to put in place, I think it's starting January of 2026, KYC and AML regimes. And so I had a client email me today saying, hey, what actually we need to do to comply with this? Like, just the minimum. Like, what's the minimum? And I told them, just wait. Like, just wait.
Yeah.
It's a new administration. Let's see what happens before January of 2026. So the notion of give it time and time may actually be a friend.
Look what happened with FinCEN.
With the CTA.
Yeah.
Yeah.
In, we're out, we're delayed, back,
a horror
forth.
show, a horror show. And thankfully it went away. And so too with the private fund advisor rules, right? Which everyone in here knows about the private fund advisory rules that was overturned by the Fifth Circuit, I think. They're like, no, you can't, LPs and GPs need to be able to put their, need to be sophisticated and negotiate for themselves and negotiate their own side letters, thank you very much. And you don't have to be, sorry if my colors are showing, you don't have to be the nanny and make sure that, David, sorry, that the ILPA is protected by the SEC. And so we revised our fund docs to build in all the private fund advisor rule, plumbing, and then thankfully we're able to strip it all out. I think getting back maybe to what we were talking about earlier, like headwinds or tailwinds, one of the reasons I'm so bullish on fundraising is because I think the market thinks that there's going to be less regulation and no more, private fund advisor rules, and maybe we'll see if my client dodges a bullet that they don't have to put in place this KYC AML regime by next year. That's going to open things up, I think. What do you think, Ken?
Yeah, fingers crossed. Fingers crossed.
In Washington in our firm who are connected to the Beltway, and they say, this is something that's being discussed right now. Keep an eye on it. Is there something that folks in this room should be keeping an eye on in terms of from a regulatory perspective that might affect them?
Regulatory or tax, I think everyone here who has a piece of carried interest is aware. That was a wee lad as a lawyer, that carried interest exemption, so it's not taxed as cap gains. That's, I don't know. Again, like I could stick my thumb in the wind and prognosticate where that's going to go, but that's obviously something that people are going to be aware of. I'm curious whether the marketing rule that came out recently, and that I can tell you is a full employment act for regulatory lawyers. Are there registered investment advisor firms in the house? So this is like painful, right? Like the SEC's position for the past few years was like legislate via enforcement and continue to focus, in my view, to open, but nitpick almost on everything, put the GPs under a microscope and keep the regulatory lawyers like very, very busy footnoting your PPMs. And my sense is that with the new administration and the new SEC chair and the new head of enforcement, I don't know if that person has been chosen yet, I feel like and what I'm reading also is that the SEC is going to get back to, let's find fraud. Let's find market manipulation, insider trading. The footnotes in the PPM are important. I'm not saying anyone can defraud anyone. We will review your PPMs. We will review them carefully.
But also what Trump did in his prior administration was focus on the smaller investors. So we didn't see these massive fines that were issued to RIA firms or issued to Wall Street for political reasons to some extent. But what I'm also told is we have legacy investigations going on right now that were started in the prior administration, but that the pace of new investigations has slowed considerably. A big piece of that is that much of the SEC has either left or been terminated. So a lot of the professionals with expertise within the SEC who know the private equity and venture capital space very well, they're no longer with the SEC. So there's a bit of a knowledge drain, and we're starting over with a new batch or generation of SEC examiners who have less experience in the space and need to be educated about the space. Mm-hmm. But yeah, I think that in addition to that, based on what happened in the prior administration, we're not going to be as worried about those massive fines flowing from foot faults anymore.
I wonder whether the accredited investor definition will be expanded.
Well, we can talk about the 506C marketing rule.
Yeah, we can. By a show of hands, does anyone market their fund on 506C And if you don't remember what that is, I always think of it as 506B means be quiet, and 506C means see me. Because 506C is where you can be very public about your fund. You can go on, you can stand up in front of you can go on a podcast and talk about your fund. Is anyone using 506C public?
So I'm surprised
so few. I'm surprised so few.
Yeah.
I actually have a lot of clients that use 506C, especially after this recent no action letter, which came out like a month ago, I want to say, that relaxed, that mitigated the downside to 506C, which we can talk about it. But if no one's really using 506C, maybe that's a reason to talk about it. You should all talk to your lawyers about 506C for your next fund, because it may be able to make your fundraising a bit easier, because
you can advertise freely. It's not a private placement. And the big change is that accredited investor test can now be satisfied through a minimum capital commitment.
Right.
Essentially. And there's a little bit of nuance there, but it's a much easier test to fulfill that demonstrates someone's an accredited investor. So we don't need reference letters from banks. We don't need reference letters from brokers. We don't need bank statements. We don't need to actually test their accreditation. We can just look at how much they're investing.
Right. If an individual is investing, I think it's 200 grand. Is it 2 or 250? I think it's 200 grand. Or if an entity is investing $1 million in your fund, you don't even need to vet via third party or other indicia that they're telling you that they're accredited. You take their word for it. And you can find them publicly on the radio, right? You can take out a full page ad in your local newspaper, raising a fund, call me here. And people who call you, as long as they invest 200 grand, I think, for an individual, or $1 million for an entity, and there are a couple other easy reps you build in, they didn't borrow the money, like a couple easy reps you add in the subscription agreement, that's great.
So there's no reason why everyone shouldn't be doing this.
I agree.
The advertisement can be spam emails, but it could also be very tasteful ads on public radio. I mean, there's lots of ways
funding,
to go at it. But in the same way that Blackstone and BlackRock and Carlyle and all of these firms have kind of burnished their reputations with the institutional community, they don't need to be quiet anymore, and they can invite everybody, via direct advertising.
Right. We're fans.
So why wouldn't everyone do that? I mean, it's going to be a competitive advantage.
Are there any other regulatory changes? Oh, is there a question back there? Oh, no, I was
thumbs up to the 506C, that's all.
Okay. Are there any regulatory changes or things you'd like to see happen that you think would facilitate greater fund formations, larger funds?
I think not all these things. I mean, less is more. This is adding by subtraction. Funds will grow when there's less impeding their growth, when there's less overhead, there's more efficient, nimble firms, because they can devote their time and their resources to investing and not paying compliance consultants and law firms and in-house compliance people to check every box and pick every nit. It's just going to open things up. So I'm a strong proponent of much less regulation. I don't have one or two in mind that I think these are bad, these should go. I'd start with the Advisors Act, personally.
This administration believes in grand gestures, though, so you can go bigger than that. I mean, we can.
I start with the Advisors Act.
We could talk about a 0% tax on carried interest. We could talk about,
it's going the opposite direction of that.
Well, maybe.
I wouldn't be averse to 0% tax.
Qualified small business rollover of gain. I mean, those rules could be expanded. I mean, there's lots of tax policies that, I could see this administration saying, hey, we're going to give you a tax incentive to invest in the U.S. Why not? Right?
Sure. Sure. The good news is that I think globally people, the slides, but the U.S. is still the number one kind of destination for capital. Globally, they're still investing more here than U.S. capital is going to Europe or to Asia or to wherever, and where foreign capital is still coming to the U.S. So
that could change.
Yeah,
for sure.
It could change.
Look, again, we're running out of time here. Want to give people a chance to ask questions if anybody has any. Okay, I think it's kind of neat to have three people. Oh, yes.
We're seeing a huge uptick, at least I think we're seeing an uptick in secondaries, sales in the secondary transaction market. College endowments are trying to get much more liquid for a whole slew of reasons. But you talk about fundraising in 2025, and it looks good. Could that secondary process put pressure in the other direction? I mean, I know it's very different types of assets, but still, people have only so much allocation.
Yeah, I think if someone's selling, they've lost confidence in that manager or that sector. And so this is what I was saying earlier about you always see a big uptick when there's some distress in the marketplace, and clearly the endowment's under a lot more stress. So from my perspective, it just leads to, okay, so maybe there's greater investment in secondary funds and secondary opportunities because the discounts that people are able to command are greater. But overall, more broadly, we'd see a slowdown in that sector. Now, those people might put their money into infrastructure, they might put their money into precious metals, they might put their money into timber. There are other asset classes where they can deploy large amounts of money, and they might just be cycling out of one into another. But you see this with every cycle.
Well, great. I do think it's a sign of the times. You have three people with probably 6 decades of experience on the panel, and you've got optimistic, you've got a little concerned, and I've got hopeful but not confident. So hopefully the conversation of having all those perspectives presented to you was helpful for your thinking and your conversations, and we wish you a good rest of the afternoon in your networking. Thanks for being here, guys.
Wonderful.
Thank you. Thank you all.